So why would people be interested in buying a house without any money down in the first place? You might be thinking. Well, the following reasons are going to help you understand that. Investing in property can be profitable and is a great method to make a consistent passive income depending on the type of strategy you have. A larger populace can access the market thanks to the diversity of possibilities for buying a house with no money down. Starting early gives you time to accumulate equity and potentially own your own property if that's what you want to do. Let's examine the following methods for purchasing property on a budget. You can take on a lodger. This is one of the most inexpensive methods to begin investing in real estate that can help you save money, which is by taking on a lodger. So there really is no upside apart from the money, I guess. You can make up to £7,500 tax-free each year under the rent a room relief, or half that amount if you're renting out the room with your spouse or your partner. Owner-occupiers and tenants who rent out their furnished house in their principal residence are qualify for obviously a rent-a-room relief, and I think it's something you ought to look at. If you're using rent-a-room relief as in you're the tenant, then this may impact your housing benefit if you sign up for rent-a-room relief, and also you won't be entitled to council tax reduction, so that's something to bear in mind. Next, real estate investment trusts. A corporation that manages, owns or finances rental property is known as a REIT or REIT, or real estate investment trust. Like mutual funds, a REIT is a business that pools the money of numerous investors to make real estate investments and create revenue. With a real estate investment, each investor receives dividends from their shares without having to finance, manage or own the actual property. As a result, REITs are analogous to money market funds in that they are a low-risk investment that yields a consistent income. P2P lending or peer-to-peer lending is a type of direct investing in which you conduct business with one person or company directly and leave the bank on red. Since no banks are involved and can take a commission, this sort of investing enables investors to achieve excellent return rates or rates of return. Peer-to-peer lending has relatively high interest rates and is generally less liquid than bank lending, both of which are typically difficult to find in real estate. They're often unsecured, so if the borrower defaults, you won't receive your money back. This is something to keep in your mind if you decide to invest in peer-to-peer lending with a specific person. Property crowdfunding, a novel method of investing in real estate that enables individuals to pool their funds and buy a portion of a property that exists in the form of property crowdfunding. Peer-to-peer lending places you in the role of mortgage provider, so to speak, but property crowdfunding grants you an equity stake in the project for the sake of giving off pick-me energy. To see significant returns on your crowdfunding investment, you'll need to hold on to your investment for a while, unlike peer-to-peer lending, which enables you to provide a short-term loan. Property lease options, one of my favorites by the way. Low-cost real estate ventures that are underutilized in my opinion are known as property lease options. They enable investors, people like you and me, to effectively control a property without making a financial commitment to it by letting them rent it out for a while. Instead, a property investor pays a small sum up front, and that depends on the figure that you negotiate to make the process legal. And it could be £1, sometimes it could be less, it could be more. And then you set a monthly fee and the length of your agreement, and then agree on a purchase price with the owner or the seller in case they decide to acquire the property outright in the future. For buy-to-let investors, again people like you and me, property leasing options are frequently attractive buys since they offer the benefit of a consistent rental income without the need for a mortgage. Joint ventures, this is one of my favorite ways of doing business or business structure. A joint venture is not where you sit in a circle with your buddies at 4:20 a.m. and pretending you are the cast of that 70s show. It is basically a simple version of property crowdfunding that takes place between two or more people, entities or businesses, because they open up a relationship that is acceptable to both of them in the world of property. Very progressive for such an old venture. The companies or entities agree to combine their resources and knowledge, experience, expertise to accomplish a particular objective or a job or a purpose. In most cases, one business supplies the funding while the other offers the technical expertise and the experience and the time and the sweat equity. They share control, ownership, rewards, rights, obligations, risks, regardless of what each party contributes to the joint venture, and the exact share of that depends obviously on the agreement and on what the individuals are contributing. But as a result, a joint venture may be the best option if you don't have money to invest in real estate, but you can find a business partner who does have the money but doesn't have the time to manage it. Using your own equity, I feel like I've taken on the role of a maths teacher here, and that there's no way to get out of it, but I am an accountant after all. So here's another lesson. Home equity is the positive difference between the value of your home and the money you must pay to repay your mortgage. So asset versus debt. Although using your equity to buy a property may be the most expensive option, or it could be the cheapest option depending on where the interest rates are when you're investing in obviously real estate, it may be a highly expensive thing to do if things don't work out, because then it's going to cost you a lot of money. As a result, you should only use this approach if you have a sunshine and rainbows kind of view on life, and only if you have extra money in hand in case there are any setbacks, and obviously those happen quite often. Basically, if you love the rain, then you should consider other options. Buying under market value and flipping. If you have the opportunity to buy below market value for a profit, which obviously is good, because obviously buying below market value, you're creating additional value, or you've got a margin there before you kick off, then you should definitely look at this as an opportunity. This is one of the simplest ways to invest in property without any money, as long as you can find an investor. But you can also go off the rails if you fail to do your proper research beforehand and keep a good handle on the project. You can find a worthwhile property through auctions, or simply go off market. That's where you really find below market deals, which are it includes obviously finding properties that have been repossessed. No, those are not homes that have got taken over by demons, just in case you're wondering. There are lenders who can provide you with a bridging loan that will save you from emptying out your own bank account, because you never want to do that. So flipping and using below market value is the right way forward, and you can get a good amount of capital gain or margin from it if you do things correctly. Remember though, there are some fees which are hidden fees or undercover, which you might not know about, so you've got to be prepared to pay in blood. I have fully embraced my dramatic side, and there is no going back now. Until next time, where I cosplay as Gandalf and do not allow you to pass till you have proven yourself worthy.